So I'm going to stop rambling now. I think I should just pass it on to Gary so that we can start to dig into this content. I am going to watch the Q&A. So if you do have questions that come up during the session, we're going to try to answer them just as we go, as it's is relevant to the slides that we're talking about. So just use the Q&A, use the chat if you have some comments for myself or for Gary, and we'll take it from there. And so Gary, you can take it away.
Well, thank you, Greg, for that introduction, and welcome everyone. Hopefully you'll find this informative and you'll be able to utilize some of the information we're going to share here today. So I've conducted a number of these and a variation of these slides. So some of the topics may or may not be relative to what you're doing currently. But again, hopefully you'll find some of the information that you may be aware of and some maybe clarification perhaps. So we'll get rolling here now. And again, if anyone has any questions, even after the session, I have my email address attached to the first slide here. So if you do have any questions after the session, please feel free to send a note. And if I don't have the answer, I can sure find it. So by all means, you're allowed to do that as we go further. Now, again, most of you are now in business currently, either proprietor or as an incorporated entity. So we'll avoid some of that entry-level information. But some of the common questions I do receive, it's essentially, when do I make that transition from hobby to business? And again, there's no real fine line or dollar amount. It's basically when you start up and running your business. As it relates, and we're going to go into more detail with proprietorship and corporation as we go through the morning. But three things really, when you're looking at when should I incorporate? Because again, I found that a lot of entrepreneurs incorporate too soon and they get ahead of themselves. But normally you would incorporate for two main reasons. One, to mitigate your liability. In other words, you want to avoid your personal assets being encumbered in the event of litigation or some other format. You know, if a supplier gets into a dispute, you know, are you responsible for that personally? So again, normally you incorporate to avoid that personal liability element. The other reason is income tax. Corporations pay a lot less income tax than the individual as a proprietorship. Just as an example, there's a provincial component of tax and a federal component. But right now in New Brunswick, the tax rate combined, federal and provincial, is 11.5%. For Nova Scotia, Newfoundland, and PEI, it's currently 12%. So again, individuals will pay a lot more income tax than the corporate rate. So that's a real reason why folks would incorporate, you know, once they're up and running and doing a little more so than just the entry-level type activity. So again, the other aspect of it, if you're finding that you need your business income for personal living expenses, you might as well remain as a proprietor, simply because if you're taking the money out, you may find that the corporation is paying an income tax and you as a proprietor are paying income tax. So again, it really negates the benefit of incorporating if you're actually taking most of the money out and having to pay that tax. And some of you may already know how to actually do when you're actually looking at the proprietorship. But again, if you're just operating under your own name, you really don't need to register your own name with anyone. It's only when you want to incorporate a specific business name, you would have to do a name search and then register with the province. Again, register that business so you're protected. So again, you've already probably have done that, so that may not be of any relevance today. If you have any questions on that, again, please advise me or during a Q&A as well. Now, very quickly, the advantages of the proprietorship are very simple. The only point on this slide I'd want to emphasize, you are linked to a calendar year reporting. So we do report from January 1st to December 31st. So again, you are linked to that corporation, and you cannot report a period exceeding 12 months. So even if you started late, for example, in late 2019, and you may want to just roll that over into the 2020 year, but just the point being, you cannot report more than the 12-month period. And the other little advantage for a sole proprietor, again, you or your partner or your spouse have until June 15th to file your income tax. And that includes your business activity as well, obviously. But again, it's somewhat of a false incentive, because even though you're allowed that an additional 45 days to compile your income tax information, any tax owing is still due by April 30th. So it really begs the question, what's the advantage of the extra 45 days when I have to actually have the taxes paid by the same expiry date or final date of April 30th? So again, basically they're seeking in the fact that if you are a sole proprietor, we would like you to pay installments every quarter, make something, and then by June 15th, you would either receive a refund or pay the difference with a small amount of interest. So that's the logic behind allowing you the extra 45 days, because they would expect you to make remittance installments. Again, the disadvantage of basically you are it for everything, tag you're it, as I've indicated. But really the challenge is you really need to look at separating the personal income expenses from the business. Trying to keep that separate has always been a challenge for small business, small proprietorships, keeping that distinct line between that business and your personal life. I'm looking at I do some backup cheat notes here if nobody minds. And really, any organization you receive money, there could be grant-based assistance. I know in New Brunswick Arts Board, for example, they're required to send out a T4A on an amount exceeding $500. So anytime you see a T, that really means it's taxable, because that used to be a common question. I received this T4A in the mail. What do I do with this? It's taxable. That income is taxable. You need to claim that. So again, anything over $500, and CRA, by the time you receive your T4A, CRA would already have that information. They receive the same copy as you would on that. So another thing is, if you fail to report T4 income twice in a 4-year period, CRA could actually levy a penalty and interest on that if you fail or didn't receive one, or T4A, or even a T4, any of the T information, T3s, T5s. Again, the onus is on you, the taxpayer, to ensure you have that information. If you don't receive it, the onus is still with you to actually try to find it. I call this one of my most important slides, is really the treatment of business income and expenses. I always recommend setting up a separate bank account for business to track your income and expenditures. It doesn't have to be a corporate bank account, but simply even a checking account. And just simply ask your bank or lender, I want to set up a separate account. Just be cautious they don't set up a corporate account, because the fees are much more, let's say, a lot higher for sure. And it's just a separate bank account. That's all you need to do. You may want to have a separate debit card, maybe use one of your existing credit cards simply to keep the business activity separate. And again, the next point on the slide, rather, you need to report all your business income. Now, even though you may receive cash, that doesn't give you a hall pass not to claim that income. If you receive cash, a check, an e-transfer, that's still all business income. Because what happens sometimes, you may be paid cash, but the individual who's paid that bill is recording that as an expense. And if they actually get audited, they can do let's say a transfer or a reflection over to who they paid out the cash. And that's how a lot of times there's a cross reference. And that's how a lot of other businesses get caught in an audit, because one other business actually paid cash, and that's how they conduct their business. However, they are expensing it. So just a word to the wise on that. And I say, if very simply, keeping like a file folder, an accordion folder for your information, January, February, March, for example, keep all your invoices for January and your expenses for January in that file folder. So therefore you can track it at the end of the year. Now you do file your tax return. Some of you may already know this, but you do file your taxes like any other year. You simply add, as a sole proprietor, a Schedule T2125. All that is a schedule separate from your other business activity, stating your business income and your business expenditures. Now, again, as a sole sorry. Great.
Well, there's a couple questions, but you can finish the slide maybe before we address them.
Okay, sure. I was just trying to, again, capture everything. And I got a few other points that I didn't put on the slide because this is a very busy slide as it is. As a sole proprietor, you may know that in the event you have a loss from business activity, you can subtract that from your other sources of income. So example, if you earn $25,000 in business income, you have $20,000, or I'm saying to say $30,000 in business expenses, that $5,000 loss can be subtracted from your other sources of income. So if you have a T4 or any other types, if you're working part-time or otherwise, you can subtract that loss from that income. Now, again, if you don't have that concern, you can carry the loss back 3 years or ahead 20 years. So you'll never really lose the loss from your business. And it's expected the first 2 years of business, you will be anticipating a loss. So Greg, I can be quiet there now for a moment if you want to, your questions.
Yeah, so one of the questions was about just this slide and setting up a separate bank account. Would it be just as easy or easier to go to a different banking institution to do that too, for your business?
Sure. I mean, that's a possibility. It's whatever works for you, the entrepreneur, really. If you can do it, if that's better for you to go to another lender, that's fine. That would make sense. As long as, again, you keep the information separate. I know I bank at one institution and my corporate bank account is still there, but again, I keep it separate. Now I'm incorporated, that's another story. But again, if that's what works for you, keep it simple, a simple system that you're going to follow. If that's easier for you, then that's the way to do it.
Yeah, and the other question was about incorporating, and you kind of mentioned you didn't have a necessary threshold for incorporating. The question is there a certain income level where you would recommend it? For example, if your business profits $80,000 with 2 people from the family working in the business, is it best to maintain that sole proprietorship if you need to use most of that profit for family expenses?
Well, again, to answer the first question, Greg, the first part, there's no threshold when you make that leap from sole proprietor to incorporation. I know an entrepreneur that's a sole proprietor and his income is over $200,000. And it's just to his benefit to remain a sole proprietor. But again, it's no threshold. However, it's a choice. But again, on the other part of the question, Greg, as far as 2 individuals, if they're utilizing all the money, they want to take all that money out, I would say remain a sole proprietor or partnership, whatever the arrangement would be. Because again, to incorporate and then take it out, the corporation may still have some reserve there that you're going to pay tax that, and you're going to pay the tax on your individual withdrawing as well. It really comes down to, do you need to take all the money out, or do you want to just take it, leave it in the corporation and just take it out later as you need it? That might be the time to actually incorporate at that point. Does that answer the question?
Yeah, I believe it does. Yeah. And then the final question currently is with regards to subtracting losses against, from your business. Can you subtract the loss against your spouse's income?
Not unless they're part of that business. Again, I guess it begs the question, who is filing the taxes for the business? We have to be a little cautious about that, simply because if you have a registered business, it's in your name, you've registered. Again, moving the money around, you got to be a little cautious about that. But again, the money, because everybody, spouses, they file their own returns separately, correct? Even though you do transfer credits back and forth, medical and donation and things you can move around. Business income, I'd be a little cautious about moving the business income around as a sole proprietor.
Okay. Thanks.
Good. Now, I guess we're into the Q&A part of that slide, but there may be other questions, Greg, as a result of that.
Nothing currently, Gary.
Okay, good. One of the questions too, which I found, and it popped up here last year as well, CRA, and I've had this conversation directly with CRA, a lot of the arts organizations only deal with sole proprietors, even though you may have a corporate entity or reporting the business income. If they've issued a T4A and the amount that you received is in a certain box, CRA wants you to report that income that's situated in that box. For example, if it's a scholarship or bursary or just a grant, they want you to claim that personally. even though you say, no, I've done it really for my business purposes. I want to fill it out. I want to include it in my schedule of business income and activities on that schedule 2125. CRA says no, they want it because they want to match it between what they have a copy of and what you submit, because it's on that T4A. So I'm not sure if that's confusing or not, but I know a lot of artists say, I don't want to claim that personally because that's why I have the business. The only way to actually go around that or circumvent that would be to file a manual return and include the T4A showing that's being diverted to the business income and the business expenditure. So that's always been a challenge with everyone filing electronically now, because CRA wants to match up the income to actually their true recipient, especially when the T4A or the T4 has your social insurance number on that form. So again, it makes it tough to put that somewhere else. And I know some entrepreneurs and sole proprietors have got T4As with like over $30,000, for example, and they want to claim expenses against that. But the resolve to that would be you'd still file your you still claim the T4A, where it's supposed to go, but on your statement of expenditures, I will still list your expenditures. And that business may be claiming a loss as a result of that, but that's the only way to really truly reflect it. Show it as the income, but show the business loss on your personal return. I hope that's not too confusing. Here's a slide which I always say, again, a little surprising, but you're now in business. Don't work for free. You may get asked from family and friends, so on, well, can you help me with this, all that kind of thing. But again, you are in business now and you should be charging for your time or your product. And again, I always set up in my what I do, I always prepare a letter of engagement. So there's no surprise, because the last thing you want to hear is from your client or your whoever, your customer, whoever you're dealing with, oh, I didn't realize you were going to charge me. You want to deal with that at the very beginning. Do a contract, a letter of engagement, something that outlines, here's what the client has asked me to do. Here are the fees. Here are the costs. Here's when I expect to be paid. And no one's giving credit terms these days. Everybody wants to be paid right away, especially the days of e-transfers. You really expect to be paid like within the same day or the next day. Nobody's giving 7-day, 30-day terms like they used to years ago. Everybody expects to be paid now. But again, I would always caution you, don't work for free. And again, make sure you have a paper contract or something in the event something goes wrong. You have a support document that if you have to pursue legal activity, you have a signed contract or a letter of engagement outlining what the terms of this arrangement would be. I want to touch on this point because Greg brought that up, and I got some cheat notes on that as well. There's a number of benefits that were available last year. Some of them have extended into 2021 as well. Some of these programs are for personal benefit, and some are for corporations, for example. So this is just a list, a few of them here. But I know what's happening on some of these individuals who applied for these things during a downturn last year didn't recognize or realize that that is income. You do need to claim this as a personal income, or for the corporation needs to claim it as income as well. Some have allowed a certain tax be deducted at source, some have not. So it's put some individuals in a little bit of a uncomfortable position, knowing this is extra income for the year, which made sense at the time. However, it's like getting the bill after a big supper. Wow, I'm not hungry now. Why am I paying this bill? That's off Seinfeld, by the way. In any event, those amounts are taxable. And one little other thing that folks didn't realize, under the emergency recovery benefit, which was an amount paid, and it's on your T4A, it's in box 202. And if your net income from all sources, less a certain part of your other deductions personally, if you have earned over $38,000, you may have to repay a portion of that social benefit. I'm just going to get my little cheat note here again. Yes, anything over, if you find your box 202, and there's an amount in there, that's the amount you would have received under the Canada Recovery Benefit. If your income from all sources is more than 38,000, you do have to repay a portion. And sometimes it could be half the amount. Sometimes individuals had another spurge in income later in the year, they may have to pay it all back. So just a word to the wise there that those programs are great. However, they didn't tell you that because they're so quick to get that money out in everybody's hands. They didn't realize the repayment feature or the taxable feature that's attached to those things. So again, some of these other ones are for businesses. For example, the emergency business account, that was a $40,000 loan. It's not a grant, it's a loan, interest-free. And again, as long as you repay it by December 31st of 2022, they'll forgive $10,000 of that amount. So there was definitely a benefit for the business. But again, the trick is make sure you repay it by that deadline, because that was the purpose, to get you over a temporary hump in the activity during that 2020 year. And you have 2 years actually to repay it, but a word to the wise on that. Are there any questions? Because I don't know how much detail you wanted on that, Greg. I know, Greg, you and I have spoke on that, but are there any thoughts or comments on those federal programs? But I want to make sure the taxable benefit and you're aware of the repayment feature as well.
There was just a clarification with regards to that $38,000 threshold. Is that net?
That's your net income.
Yeah.
There's gross income, there's net income, then there's taxable income. So I believe it's on the 3rd page of your tax return. If your net income, and if you're using software, it does the calculation for you, but just so you're aware that it is net income in excess of $38,000 from all sources. And again, a lot of folks, recipients, were not aware of that repayment element. But that's CRA working at its best.
There's another question regarding the Regional Relief Recovery Fund. So 10,000 is non-payable. Is that taxed 12% for somebody who is incorporated?
Again, let me try to think. I'm just trying to. Sorry, I'm just going to grab my little cheat note here if I could. Yep. Yeah, well, again, that was available to corporate entities, correct? That was it. We're talking about the Canada Emergency Business Account?
Yeah, I believe it is, yeah. Or
there's so many of these, it's really
a lot of programs.
Yeah, and again, I'm trying to grab my little notes here. Yeah, it's 0% interest for the first 2 years, that exemption. And then really what it is, the banks have actually distributed that money. It's a bank loan. The federal government is simply a guarantor of that loan. Now, I did hear the figure of 12% annually on that balance if you're making arrangement. But basically, you have to go into your lender where you receive the money and say, okay, I want to set up a repayment. And I understand by talking to the various bank managers that it's somewhat a little flexible as far as the repayment time. It is a bank loan. The federal government wants you to sort it out with your bank, but I understood it was a 12% interest rate set out anyways, but you may be able to negotiate a better term depending with your lending. As long as you had a business account, your bank really is responsible for that loan and the repayment of that loan.
So is that considered income?
No, a loan is not income. No. A loan is a loan. And again, right, sorry, Greg, sorry.
Oh, I was just going to clarify. So yeah, that's the $10,000 would have been from distributed by a COA, right? The Regional Relief Fund. Yeah.
Yes, so, I understand.
Or through CBDC.
Yes.
Yeah. So
that's correct. Yes, it is a loan. Loan is not considered income. Grant-based assistance is considered income. It's considered other income or something. So again, you do have to claim that as income, grant-based assistance. But the loan, again, is subject to interest. The interest part of it would be an expense item on your income statement. All right, again, this really applies again to corporations, but I'll talk about corporations a little later because they have an extra feature for home-based expenses. And this is a common question as well. If you're operating from your home or anyone else or any location like that, the other question is, again, some folks are residing with someone else, or let's say if someone is living at home with their parents, for example, if the parents are paying the expense, you really would not be permitted to actually claim expense if you're not actually paying those bills. And CRA allows you to claim a reasonable expense in the course of earning income. So again, anything that's deemed to be reasonable, and I always say that's subject to interpretation, determination of reasonable. Now you can use the number of rooms or the percentage of your occupancy. So ideally, if you're, let's say, in your home or even in an apartment situation, if you're using that as an office, and CRA only allows you to have one office. So in other words, if you have an office at the place of business, you really don't want you, they want you claiming in a home office if you have two offices, for example. So that's subject to discussions again as well. So again, the number of rooms, if you have 10 rooms in your house, you're working in one room, obviously you can claim a 10% cost, and we'll go into more detail of what you can claim, or the percentage of occupancy. So if you know the square footage, your office or the room you're working in is 10 or 12% of that total occupancy, that's the amount we did use. But the place should look like a place of business. They're disallowing a kitchen table, or if it's a bedroom by day, office by, or bedroom by night, office by day. As long as it looks like an office, you can probably get away with the bedroom situation if you have a table and a desk and a computer, filing cabinets, those type of assets sitting in your office. But again, make sure if CRA or any other one was to walk into your place of business, does it look like you're maintaining an office here? And the other things you may want to have a discussion with would be your home insurance company. Because again, if you don't advise them you're actually conducting business, something would happen, heaven forbid, the insurance may not come to your rescue. For example, a third-party liability, if someone should show up and slip and fall and sues you for whatever reason, you didn't chop away all the ice, for example, they may say, well, we weren't aware that you're doing that. But try to avoid, you're just really advising them, try to avoid having to buy a corporate liability package, because that can be very expensive. It can be $1,000 or $1,500, for example. So just, again, be cautious. But I mean, if you're having that conversation, I would do it by email, so you have a record in the event of a claim that you are covered in the event of something happens, for example. And the other one is zoning. If you are working from home, you're living in a community with this R1 or R2, which means residential residences, and you have a lot of cars showing up at your door, parking on the road and so on, a neighbor complains, the municipality or the rural area may have an issue with respect to the fact that you're conducting a business in a residential area. That doesn't happen very often, but normally if somebody complains, you have to be cautious of the fact that I am running a business from home. Home-based offices are fine. You just have to keep it with limited people showing up to do business at your home. Now, what expenses you can claim is a percent, that same percentage you talked about, be it 10 or 12% or 15, whatever the place may be. The other thing too, again, you may have if you have a studio, for example, in your home, that may allow you, or you're working out of your basement, for example, that may allow you an additional percentage as well if you have a larger location for your business, if you're operating from home. But it's a percentage of your mortgage interest, not the payment. It's just the interest component of that business. And again, percent of the rent as well. Property tax, the power, snow removal, water and sewage, repairs as long as they're reasonable, home improvements as long as they're reasonable. I would avoid amortization, which is really depreciation of the home, because when you sell the home, you could be subject to a recapture of that amount. In other words, they'd expect you to pay that back. So again, those are the type of home-based expenses you can subtract from your business income. The only little caveat that goes with this, you can use home-based expenses to bring your income lower or even to zero. You simply can't use home bases to increase the loss rather below zero. Sorry, got confused there myself. So again, in the event your home-based expenses create a loss, CRA will allow you to claim to zero, and you simply carry forward that remaining expense from your home-based expenses. So you'll simply carry that forward until such time you can utilize that amount of money as a loss. Does that make sense, or is there any confusion there? Is that good, Greg? Is that
There's a question, Jerry, about
okay?
whether if you run two businesses and you're using separate rooms, you can claim those separate workspaces.
That is correct. Yes. I know spouses, for example, that have that situation, that they both have two different rooms, especially under the COVID situation. Again, you're allowed to use different. If they're using same space, will be one thing. No, if it's a different room, that's fine. And the other thing with, sorry, Greg, sorry.
Oh, just a question came in the chat. What about a vehicle that's owned by a shareholder that is used for the business?
We're going to talk about vehicle in the coming slide. Yeah,
vehicles coming
that's
up,
right.
Yeah.
Now, under the COVID thing, when you're working from home, I know if you have another business or another job, for example, I know CRA is allowing some home-based expenses if you're asked to work from home. If you normally had an office, for example, an office environment, but you were sent home, there is an element that you can claim that as well. But this is different because you wouldn't be allowed to claim the home-based expenses in addition to that provision if you're working from home, if you had another job, for example. So this is a situation if you had a part-time business versus working somewhere else. So you can't claim both of those. So any questions there? Because I think our next slide is the vehicle. All right, we'll move right along. Actually, we're moving pretty good time, Greg, if I'm not mistaken. We're doing quite well, actually.
Perfect.
So again, really, you need to keep a vehicle log, Greg, but I can answer that question maybe first if you want to just repeat that again, and then we'll go into the details.
Sure. The question was, what about a vehicle that's owned by a shareholder that's used for the business that's incorporated? So,
but the individual that's using it isn't paying the expense, like the payments and the operation of the vehicle.
Yeah, it sounds like the vehicle that's being used for the business. Oh, the shareholder is paying expenses for the vehicle.
Okay.
So is that
like almost like a reimbursement? Again, normally you're claiming expenses that you are paying, but this slide may answer the question, I guess. But if not, we'll come back to the question in any event. You do need to keep a vehicle log, and I know that's a lot of administrative work to keep a vehicle log, because you really should be recording the beginning kilometers on January 1st, and then the ending kilometers on December 31st, and track your business activities. Like on today, for example, if you drove somewhere to sit down for the meeting, for example, you would, all right, today's March the 30th, my beginning kilometers are this amount, my ending kilometers are this. Here's the date, here's the location, here's the purpose of the trip. A real one line, 2 or 3 things. I always keep a notepad of my vehicle, and then at the end of the week, I export that into an Excel spreadsheet. So I track that information, does the multiplication adding for me. And again, it's very clear in the event you are asked, you're using and claiming expenses, I just be careful of just saying, well, no, here's the kilometers I use, I didn't record anything. You could be challenged for that. The more records you have to support your claim, the better. You really should be keeping a log so you can actually defend it if you are challenged. So again, you need to keep the total kilometers for the year and the number of kilometers used for the business. Now, here would be an example. So again, depending on what you are paying out for the vehicle, some entrepreneurs have told me they simply just have the gas paid for. Now, if you're going to a day trip, let's say to wherever it may be for the day, now are you utilizing all the gas that you paid for? So again, you're really not receiving the full benefit if you're doing that. Because again, the kilometers right now, there's for corporations, you actually get a federal rate, or you can do this as well. So the corporation has an advantage because they can claim the same process of the percentage in the kilometers, but they can use a federal rate instead of doing all these other calculations. But again, you can claim 15% of the loan interest or lease payment, if that's the, kilometer in this example, and then a percentage of gas, insurance. Again, I'd avoid depreciating the vehicle if you could. But again, you're allowed to claim that percentage of those costs as a business expense. So again, if the individual is simply making those payments, if they're expensing those items, then yes, they can claim that amount, even if the vehicle belongs to someone else. As long as you're expensing it and paying for those, yeah, there's no reason why you wouldn't be able to claim that as a legitimate expense. Does that answer that question?
Yeah, I think that answered it, Gary.
All right.
Yeah.
But again, it's like I say, some folks, again, have a difficult time with the home-based expenses and the personal vehicle simply because, again, not knowing what, and no one's looking for pinpoint accuracy. It's basically allowing you to claim reasonable expenses in order to incur your business. And these basic principles apply to pretty well all business sectors. Right? We're talking crafts today, but again, the arts community or any other type of business. That's why I kept these slides very general, because again, the same rules apply regardless of the industry you're in. So these are fundamental things that are available to most business activities, sectors. So here's our break time. And again, we're already 45 minutes into it, so we're doing quite well, actually. Do we want a 10-minute break? Does that work for everyone?
I think 10 minutes sounds good. We haven't really been going for too long at this point.
No.
So
all right.
Let's take a 10 and
I get 9:41, 9:42.
Yeah.
So yes, 10 minutes, for example. And we'll come back and we're going to talk about the actual filing that statement 2125. And we're also going to get into a discussion on the cost of goods sold, because I understand that was of a topic of importance that we can get into some more detail on that when we come back.
Perfect.
So we'll see everyone at about
10. Maybe 5-2 or just before 5-2.
All right, fair enough. I'll see everyone then.
Thank you. Hey Gary, there's a couple of questions that maybe we can, couple of questions we can maybe do clarification on before resuming.
Sure. I was going to bring up that thing about the recovery benefit too, to make sure there's no confusion there. So sure, we can answer those things. Great, by all means.
Sure. There's a couple more coming in. So one was about the vehicle. So if you use your vehicle to exclusively travel for business, and like almost not at all for personal reasons, how do you account for gas and maintenance on that?
Well, in that, if you can really make an argument that it is full-time use, very little, I think you can claim basically your expenses, all your gas, your maintenance, your repairs.
So just track all those
I would
expenses.
say track those, make sure you have that support. I always say the more support documentation you have, the better. Because if you ever get audited, CRA at the best of times has a limited sense of adventure. So again, you can't, you can make the best argument. I think they're reasonable if you can show them here. Yes, I do. I have another vehicle over and above this vehicle, for personal. Then you've got an argument that I'm going to claim everything. And a lot of business owners in the years gone by have always claimed the entire vehicle, but now, because there's been some abuse of that system, unfortunately, CRA is counteracted by saying we want you to keep a vehicle log. And I know people who've been challenged on that.
Do I have to be able to provide like my calendar to CRA too, potentially?
Well,
To
again,
show, all my
if
meetings and everything that I was traveling for, workshops, all that.
if you're asked for it, it wouldn't hurt, but you're right. You don't have to provide that until you are asked. The tax system in Canada is based on self-assessment, and you're filing it based on your, honesty and the knowledge of this information. So here it is based on my self-assessment and my good word and my honesty and integrity. And they may come back and say, we just want the information. So right now, because everyone is filing electronically, you're not providing the support. So I think there's more audits going on now because of that, because they're not getting that support documentation. But I know in the construction industry, they're audited regularly because of the subcontracts, and people are still working under the table, getting cash and all that kind of stuff. So you just have to be cautious about those kind of things, but you don't have to provide it until you're asked. But I keep an Excel spreadsheet. And again, a real one-liner. Today I went to the bank to make a deposit, so I mean, there's little things like that. You just one line, 2 or 3 words that'll trigger a memory in mind. Okay, what did I do that day? But they're just looking for abuse of the system that you are, using it personally and claiming the personal travel. If you go for a trip on vacation, are you claiming that as a business expense?
Yeah.
Meals are a big one too. Meals, you got to watch those kind of things, meals and entertainment and things, and paying employee, which I'll talk to maybe in a moment here about what's control. When do you actually make someone employee as opposed to a casual employee or a contract employee? I can talk about that too in a moment. Whenever you think you're ready, Greg, we can start. Oh, sure.
Yeah, there's a question too. There's a couple more questions maybe before we resume. There is one for use of home, and when you're a business claiming for your business, do I claim the percentage of the space in my home that I use for the business? And is it, because I just filed my taxes as an employee.
Yes.
And I was claiming the space that I use as a percentage of my total home.
Correct.
And then I could claim a percentage of my internet costs and a percentage of my bills. Is that the same?
Similar, very similar. Again, as I mentioned before, you're doing the same thing as if you were running a business from home. That little caveat that the government offered for employees that once had an office now or were sent home, you're basically claiming the same approach as if you're doing that full-time as a business owner. Yes. Same percentage. Now, again, they want you to do it for the number of months you were home, as opposed to most of businesses are, 12-month operations.
So if you always operate your business out of the home, then you can just claim it. Okay, this is the space in my home that is for my business, and the percentage of my monthly bill that covers that space is what I'm going to claim.
Yes. I know, again, you got to watch when you're claiming space. the common area. For example, if your office is at the end of the hall, for example, do I claim someone has to walk through my kitchen, down the hallway into the office?
Right.
Can I claim that common area? The answer would be no. You're claiming the actual workstation or the workspace itself. And again, it has to be reasonable. I know entrepreneurs that try to claim 50% of the home because, again, when someone comes in to visit or a client, they may sit at the kitchen table, they may sit around, but you may sit anywhere else, I should say, in the living room area. You have to be careful. Where is the office here? So just claim the actual work portion. And again, if you don't know the square footage, and most people would not know the square footage of their home or their apartment, if they're in an apartment situation. Again, it's a guesstimate. Use the number of rooms. If you have 10 rooms or 8 rooms, use that one room, for example, but it should look like an office and so on.
Do you see this other question that's in the chat with
I
regards to the not-for-profit that is contracting somebody to they have this grant to contract somebody?
Yes, I didn't see the question, Greg. All I see is my presentation because I guess.
Okay. So I'll read it out to you. So a local
Okay.
not-for-profit agency got a federal grant of $25,000 for a community pottery program. Our incorporation was just awarded the contract for the program. Is that considered income and is it applicable to 12% income tax and 15% HST/GST?
We're going to talk about HST, sorry. But again, if you receive that money, you're right. The recipient of that is income, but you're going to offset it by those expenses, right? You've contracted out labor, you've contracted out someone. It is subject to
the question is being posed from the person who is being contracted. So they don't have the grant. They're receiving remuneration for their work, right?
Yes, that is income in the hands of the recipient. Because regardless of the source of where that comes, it's still determined to be income. And the nonprofit would have actually issued a T4, I believe, a T4. I don't think it would have been a T4A. It might have been a T4, depending if they're taking deductions or not as well. Depending what the arrangement was between the organization and the recipient, were they deemed to be an employee or were they a contract individual? Right. But that is income in their hands. Again, the other one I talked about, sorry, Greg, I never want to interrupt when you're...
No, they're just clarifying that they are a contractor in this situation.
Yes, okay, and that's fine. Now, part of that, I'm just going to throw out a couple of other things we breeze by, but control it, because most businesses would rather hire a contract person because they don't have to maintain, because the sole proprietor or the corporation, once you hire someone as an employee, you must remit the employer's portion of the Canada Pension Plan, employment insurance, and if you have 3 or more employees, you have to have WorkSafe NB premiums as well. It used to be workman's compensation, but now it's workforce compensation. Anyways, it's expensive to have employees, so a lot of employers have decided to simply contract people out, but CRA has made the determination, it's called who has control. So if you've got an employee or a contract person, who has control of where they work, when do they work, how much money they're receiving, all those type of things come under control. Who has control of that? So that's where the determination is made. So even as a contract employee, do you have other things going on? And I think that's the argument you can make. This employee that I've contracted out, or as a casual employee, has other businesses. They do other businesses over and above what work I've given them. So therefore, they're not solely responsible to my, to my company or to my business. But again, you have to watch that when they're considered casual or contract workers, because CRA would prefer you make that deduction and remit that taxes on a regular basis. So just a word of the wise, you have to be cautious of how you treat an employee or a contract person because of the element of control.
Okay, do you want to resume?
Sure, we can do that. And again, the other point, I just want to make sure there's no confusion. On that, I mentioned that repayment of the $38,000 threshold. That's only if you received the Canada Recovery Benefit and the amount on the T4A is in box 202. It doesn't apply to all the other programs, specifically that one, because that's deemed to be a social benefit program. So again, it's only if you receive in that box of 202 on your T4A would apply. Because again, CRA does claw back other income when you find when you're older, the old age pension, if your threshold is above a certain level, they'll want you to repay your old age pension too, for example. And again, if you're receiving EI premiums, or EI benefits, for example, and your net income is over $67,000, they'll want you to repay part of your employment insurance benefits. So there are clawbacks of social programs because it's based on need. And in CRA's determination, if you're making above those certain thresholds, you don't need the money. Now, that's an argument you could probably battle back and forth. However, they drew a line in the sand. These are the maximums we want you to receive. Otherwise, you repay the money. Okay. Now, this is the schedule I talked about, I should say, beforehand. That's Schedule 2125. And there's a different grouping, whether it's business activity or professional activities, as a sole proprietor. This only applies if you're a sole proprietor. So this schedule is affixed to your tax return. You still claim all your other activities. If you had a T4, T4A, you had those other federal support program, incomes, you still report that as always. This is simply a schedule you include with your tax return for your business activity. So these are the different sections here. And again, you would populate this identification, your name, the business name, the address, the period that it's covering. For example, you do have to go into find the industry code. What industry does this apply? And you have to go through in a drop box of all the different, because they want to match that up to other industry sectors to make sure they understand the type of business you're operating. Whether it's a full 100% or is it 50%, is someone else working with you under this business name? And again, the name if anyone's preparing the return. So that's just identification of you. And again, they want to see your social insurance number or the business number if you've registered that business as well. This would show your income here too. They want to know what income you received, if there's any HST. We're going to talk about HST in a coming slide, and again, and so on. But I want to have a little discussion because I understand this was of some importance, the cost of goods sold section in determining the actual inventory as well as your gross profit. I made some notes here too. And really the cost of goods sold section is normally used for those who are making or producing or assembling a product. So essentially you're taking a raw material, you're putting a whole lot of other costs and items in that item, and you actually produce a finished product. You now have a finished product. And again, by putting all these costs in one area, you're actually providing a true cost of what the product is that you're selling. So what you need to do, and again, if you only have a small amount of inventory, a very small turnover from the beginning of the year, the ending of the year, you pretty well sell everything. CRA would allow you to simply record all those things under purchases. So again, if you purchase materials, you put it together, you assemble it, away it goes. If you're not having inventory, simply expense all those costs under purchases. Now, in all likelihood, you probably do have an opening inventory. So opening inventory would be at the beginning of the year, what is your inventory? And no surprise, your ending inventory for 1 year is the opening inventory for the beginning of the next year. So again, when you opening inventory could be all your raw materials, your goods in process, including your finished goods. So it's the value of all the parts of the products. And again, how you start the year is your inventory. Now, again, I don't want to get this too complicated, but again, for the inventory value, it is the lower of cost or realizationable value of your inventory. That being, if you're carrying the same inventory from year to year to year, does it still have the same value it did when you bought it? So you could have obsolete inventory that you're no longer using. You basically, what is this worth? Now, normally, if you bought it and you have an invoice, this is what I paid for it. That's your original cost. No question, no argument. However, it can lose value if it becomes obsolete or gets broken or whatever, mishandled, dirty, whatever the case may be. It loses its value. That's up to you to make that determination and what that value would be. When in doubt, simply use the cost. So really, in business, to determine the true cost, you have to start with your opening inventory, including raw materials and the finished product itself. Then you would add the purchases for the year. Now, again, you can report this information as frequently as you want. A lot of times it's at the end of the year, which is fine. But a lot of business owners prefer to do quarterly statements, even monthly statements. So again, that requires more work because you have to keep updating that information. So the cost of purchases can be the parts or materials, finished goods, the cost of materials and supplies that are used to make or ship the products. So it's not just, again, the purchase itself, but it could be your freight, your shipping containers, warehouse expenses, and a portion of the rent and electricity if you want to get to those finite details. So again, what are the true cost of my purchases? And if you have a labor cost, in other words, you have certain individuals actually hired to work in producing and manufacturing those products, you would include that in the cost of goods sold as well. So any direct wages, if someone's spending their time pretty well full time in that area, you include that in there. Any subcontractors that you would hire, or any kind of activities that you would hire someone to work on that manufacturing process would be in there. And then any other costs that you may have that attributed to the production of that cost. So again, we're taking a raw material or something that you're producing and coming up with a product that you're going to sell. And then you minus the closing inventory, whatever inventory at the end of the year you subtract that, and that determines your cost of goods sold. Now, right above that line, I'll go back a step. Once you get the other costs, that's the cost of goods available for sale. Then you subtract your closing inventory to come to your cost of goods sold. Then you subtract your gross income from your cost of goods sold, and that's your gross profit. Because again, some industries want that information. They want to separate that information because they want to know, are they actually making money on this or are they losing money? So they want to determine the true cost of manufacturing. I tried to keep that fairly simple as best I could. Greg, do you feed any questions on that section?
I think that's good. There was just a question about if you're using a software, will the software like automatically create these sections for me to fill out as you're working through it?
The next cost goes into some of these other administrative and selling costs. Now, if you're using, let's say, digital things, I know I use the example of someone wants you to make something for them and you're using a digital software. You could put some of that cost in this section. I know, for example, you're buying kitchen cabinets is a good example. They actually do a digital, they actually create your kitchen cabinet for you with the colors and the patterns and styles. Some of that cost could show up in here as other costs because it is related to the production of what you're doing. But again, some would prefer to treat it down in the below section, which is a selling or administrative type expenses, which we're going to go through shortly. But again, it really comes down to, if that's what you consider part of the cost of producing it, then I would keep it in here. Some of these things can go in either location. Some costs really should be put here, for example, the actual inventory, for example. Some of those things like a computer software maybe it can actually divide it if you want. Some in this section, some in the below the line section.
Okay,
I hope
here's an
that,
interesting question, actually, Gary.
yes,
If you're working with a raw material where the value of it might fluctuate drastically, say
yes.
silver, and I close my year and my stock of silver is worth $100, and when I open the next year, well, all of a sudden it's worth $300. Should I use that current value of it or what I paid for it?
Well, again, you have to be careful. Your opening inventory one year is the ending inventory in the other year. I think if
Right.
you do that, you might get into variation because they do want this thing lower of cost or realizational value. Now that's a very interesting point because again, that is the true value, but it is the lower of cost or realizational value. And again, my fear would be that could distort your financial results. That's all. That's my,
Yeah. Okay.
I'm not sure that's a true answer to the question, but
It's a
again,
tricky one. Yeah.
it is again, and that's a valid question because again, that's a good example of how that could vary. I think you could show that in another part of the business, which would be gain. There's a gain. Like you can go gain or loss on certain things. If you sold an asset, for example, uh, you can do a loss or a gain on the sale of an asset. So there could be a gain on value of inventory. If you want to show it there as a separate, maybe you want to show it as a separate line item. I guess I would ask who's ever preparing, unless you're doing your own, who's actually preparing the financial statements or the report here. What's their interpretation? Because again, I don't think you get a straight answer from CRA to tell you the truth on something like that.
Yeah. Okay.
And then the other expenses, again, are simply operating expenses. Some of them are selling, administrative, office, and again, and we talked earlier about meals and entertainment, for example. That's one they watch for. Oddly enough, when it says they're allowable part only, CRA allows you to claim 50% of the cost of meals. The logic being you have to eat anyways, but since you're on business, will allow you to claim a portion of that meal. So again, you want to record the true cost because that's your outlay of the cost. However, for tax purposes, you only allow you to claim 50% of the cost of the meal. Now, entertainment, I think you're a little bit, if you're having a office gathering, for example, or at the end of the year or something like that, I'd be tempted to claim the whole thing. CRA may have an interpretation of that, but again, there's certain allowances for the entertainment or element of that, I guess what I'm trying to say. But a regular meal, even if you're traveling with an employee, they would only want you to claim 50% of that meal. I get a little problem with that. If you're on business, you're on business. However, CRA looks at it differently. And again, bad debts is one, for example. A bad debt is something you can't collect. You've sold something to someone and they didn't pay you. Now, you still have to include that in your sales. And that's the crazy part. If someone doesn't pay you, it was at one time an account, it was a sale or accounts receivable. So you still have to claim that sale, but you offset it by claiming it as a bad debt. So it's a flow through, it's in and out in that sense. But these are some of the normal things you would look for in that statement, some of the expenses. And that's the part too. This is what shows up on that statement. If you have other expenses, you have to try to mirror whatever those expenses are and put it in one of those categories. Because other than the other capital costs, for example, other expenses, if you have a unique type of cost, you have to try to find a home in one of those categories. Now, again, here's where we talked earlier about the home use. Above the line, we talked about what's the total net income. And again, here are the home-based expenses. We talked about the heat, electricity, insurance, all those mortgage interest. So here's where you determine those expenses. But again, anytime you actually have a loss, you cannot use the home-based expenses to further that loss. And as you can see down below here, right above a line 1, the amount carried forward from previous year. So again, you would use you claim the actual costs, subtracted your personal portion, and that would be your home-based expenses that you're allowed to claim. But again, anything below zero, you have to carry forward until you can use it. So that's how you that is how you would calculate that amount. You can see it's business use of home expenses available to carry forward. And if you're using a software, that'll be calculated for you every year. Any questions or confusion on that part of it? The other interesting part, again, you may have heard about depreciation or amortization, calculation of the capital cost allowance. If you have an asset, and there's no real fine definition, but normally the $500 rule applies. If you buy an asset, it could be a desk, it could be a computer. If the asset you're buying has a useful life beyond 1 year, or a lengthy of any beyond a year, 2 years, 5 years, you have to amortize that over the useful life. You cannot expense the full cost that you paid. And again, this would be net of HST. So if you bought something for $2,000, you go on, there's a website, or you can find these schedules, and the guessing work is taken out. You don't need that because it's clarified in the capital cost allowance schedule. Different assets have a different class. So there's class numbers 1, 5, 6, 8, 10, 12, right up to 45 or 50. So whatever asset you could find, go through what that asset is. If it's a computer, even a vehicle that you bought, again, equipment, machinery, all those things have a separate class, and they are depreciated or amortized differently because there's different rates. Some are actually, like computers now, I believe they're 50%. Some software is 100%, so you can't expense it all, but it depends what it is. So you try to find the home for whatever that asset is that you bought, find the capital cost allowance schedule, and you make that determination. And again, you can expense that over the useful life. And CRA has estimated what that useful life would be. Again, some assets are 5 years, some are 10 years, some are 1 year, some are 2 years. So again, they can all vary. So you have to track that. And again, the other little confusing element, the cost of additions, you only can depreciate, it's called a half-year rule. So only a half of the depreciation can be claimed in the year you acquired it and the year you dispose of it. Because it's partway through the year, they're allowing you only half that amount that you would normally carry in any full year. So again, you're only getting the value as an expense of that amount allowed each year. Did that create any questions or comments? And again, some of you may already know that, you're already doing it, and that's fine, but that's just a clarification of how those amounts are determined. And again, here's your vehicle we talked about earlier. The kilometers you drove to earn business divided by the total kilometers, which will give you the percentage, and you list all these expenditures. Then you do the calculation of business use, personal use, and that's the amount you claim. Okay, we're moving on again. Feel free to ask. If you have a question anyways, we can always go back to the slide or the specific point. Harmonized sales tax. This applies to both a proprietorship and the incorporation. Now, technically, you do not have to apply for HST until you reach a threshold of $30,000 in a 12-month period. So again, until you reach that $30,000 in a 12-month period, you do not have to, and there's no retroactive treatment. Once you register, and you have to register first, until you're registered, you cannot charge or expense the HST part of it that you've collected or you paid. So you have to register first. And that could be a simple phone call. But lately, I tried to actually call CRA on this very topic yesterday, and they said the average wait time was 45 minutes to an hour. If you want to call back, please leave your number, which I did. And that was at 3:15 yesterday, and I still haven't heard from them. So getting through to CRA right now may be a bit of a challenge. But again, the threshold is 30,000. Once you reach that level, then you really are required to register to collect and remit the HST. Now, again, you can actually register prior to reaching that level if you wish, because normally in business startups, you're going to have more expenses than you are amount you've collected. So you actually could receive a refund. Because when you're filing HST, you look at what you've collected and then the expenses that you've paid HST, and you subtract the difference, which could yield an amount owing or an amount refunded. So again, you do get a little bit of a benefit because you can subtract the amount of HST you've paid on purchases and inventory or any other expense. Now, be advised, I guess, that HST is neither income or an expense. It does not appear on your income statement. Because again, it's net of HST collected and HST paid. So we're reporting the net amounts. So you won't see HST on a financial statement, on the income statement, I should say that.
Gary, there's a question with
Yes.
regards to HST.
Yes.
And it's about if I had an HST number from a past business that is no longer active, and now I'm using that HST number for my art business, do I have to, but I don't have that 30,000 threshold crossed yet. Do I have to be collecting HST because I have the HST number?
Well, again, I guess it's hard to say. Did it go dormant, or did you actually? Yeah.
It was a different business. It was so they clarified that it was as a realtor that they had acquired this HST number for a personal business, and now they've shifted gears.
I would say that HST number really is no longer applicable. I guess you should have maybe advised, or even by letter, saying, this is no longer not, just so there's no missing element that they don't come back and want you to file they call it a nil return. Because again, they want you to, if it's still, I guess it would still be active in the sense that you didn't give that up. You didn't, release that information. Because again, even if you have no activities, CRA still expects you to file returns based on be it quarterly, monthly, yearly, whatever you did, and you submit a nil return.
And they were filing nil returns for it.
Okay, all right, okay, because that is required to file regardless of activity. I would say you're in a different business. Yeah, you're starting over in that context. You're right, and then you may need to reapply at such time you wish to. But again, once you reach that 30,000 threshold, you will be required to. Hope that answers?
Makes sense. I think that's good.
That goes into our Q&A anyways, Greg, so that was just timing.
Yeah.
If not, I still think we're pretty good for time here. It's 10:25 so we're still doing well.
Okay. Any other questions about
what we've covered so far? Yeah. HST or any other information we've covered? And again, some folks may have already been doing a lot of this. It could be a refresher. It could be a couple of points they may have picked up on that could be a new. Now we're going to talk about incorporation, making that leap to incorporation. For those sole proprietors out there that have a registered registered proprietorship, you can simply now jump to incorporation. Now, if you have an HST number of the sole proprietor and you wish to incorporate, CRA will give you a new HST number. I did that because I'm incorporated now. I did have an HST number under my proprietorship, and CRA gave me a new one once I've incorporated. Because incorporation is really a separate entity. It's almost like a person was born. It's a new element. It's a new person. It's a new entity. It wants its own I guess, identity in that sense. So again, you do relinquish the HST number that you had. You relinquish the name. You have to call it cessation of that business name, and then you simply incorporate, especially if you want to use the same business name and then have it incorporated with INC or limited after the name or whatever it may be. And you can do this online yourself for $262. That's the cost in New Brunswick. I assume it must be fairly similar in the other Atlantic provinces. And you go through the corporate registry, whichever province you're in, and determine that. But again, you can do it online if you're savvy that way. It's not that complicated. Or you can still utilize your lawyer. I never want to, rule out the fact that you may feel more comfortable giving it to a lawyer or even an accounting firm to actually do that for you, an accountant to do it as well on your behalf. The fees will be, probably $500 or $1,000 plus disbursements. But again, you are able to do it on your own if you want without that extra cost. It's your call. And again, some of those already in corporation would know this. You have limited liability once you've incorporated. However, you're not always completely exempt when you make that jump into incorporation, especially if you're getting a bank loan. The banks, at the best of times, want to make sure they're secured. The banks will always do even if you're going for a corporate loan, they'll do a personal credit check because they want the owners, the personal individual, to have responsibility for the corporation. So they may ask you, in all likelihood, will ask you for personal guarantee on any loans you acquire, even if you're incorporated. So again, even though you have some limited personal liability, you're not always, carte blanche for being not held for personal liability for your business obligations. Even some landlords, when you're renting a location, may want your personal signature. You do pay a lower corporate rate than personal returns, and we mentioned that earlier. It's a clear separation of your business income and expenses. And again, some contracts that you enter into insist on you being incorporated. And if you're going to raise capital and issue shares, you would definitely need to be incorporated. Now, as it relates to disadvantages, again, much more record keeping and paperwork involved. You have surveys, you have reporting. Every year you must complete an annual return of corporations, which is around $60. That's what it costs in New Brunswick to keep your name registered with a corporate registry office. That's done annually. You actually prepare a set of financial statements, which is a balance sheet, income statements, and maybe other statements that you need to complete as well. And again, you could end up in double taxation if you're paying income tax on wages and then you're paying a corporate tax as well. So again, depending on how you set up the corporation, there are other taxes to consider. And you may have other shareholders now in the decision making, and you have a board of directors. And even if you're by yourself as you're really still a sole owner of the corporation, CERB would like you to actually have a board of directors meeting and minutes recorded at least once a year. I have to admit, I don't do that faithfully, especially when you're on your own. You have a meeting because you're by yourself anyways. But again, you should record that just if there's any changes to the corporation. Do you want to change your share structure? Do you want, those things should be recorded in your minutes. Minute book is simply a book that you would keep. Doesn't have anything fancy. It's a book to record any activities you're going on. Now, again, home-based expenses, you can do the same as you did for a sole proprietor, but you may want to consider, and again, showing this on your income statement simply as rent. You need to determine what your home-based expenses are, and that would be the amount of rent you would charge. Now, there's an offsetting side to this equation. You're expensing your home use as a rental cost to the corporation, but you personally have to claim that rent that you're charging the corporation as rental income personally. But you're allowed to claim your home-based expenses to offset that, so it should come to zero. So in other words, you claim the rental income as income. The corporation gets the benefit of an expense of rent, but you offset the rental income that you're claiming by those, like your mortgage insurance, or mortgage interest, home insurance, operating electricity costs, all those things to bring your rental income to zero. So it's a win-win for you. It's a win-win for the corporation. Is that confusing to anyone? And maybe you're already doing it. So again, I don't know how you report those type of expenditures. All right, personal vehicle. Again, I mentioned when we were doing it earlier, you can still determine the business use of your vehicle, or you can simply claim a kilometer charge at the federal rate. So in other words, you charge right now for 2020 and 2021, the federal rate is 59 cents a kilometer. You still need to keep a vehicle log, unless you're claiming the full rate. If you have a full-time vehicle for business, you keep a vehicle log, and once a month or whatever, however you report it, you claim 59 cents a kilometer. Now you don't get to claim, now this is a business claiming that, so you don't get to claim all your gas, your repairs, your car washes, all that stuff comes off the table. You're simply claiming 59 cents a kilometer. In the event of major repairs, you cannot expense that. You're being reimbursed at that vehicle rate. And what I do at the end of the month, where I'm incorporated, I determine what expenses I paid personally, including the vehicles, because it's my vehicle. I reimburse myself at the end of every month at that kilometer rate. And the expense is still expense in the business, but you're reimbursing yourself for that cost. Are we okay with that approach? Again, or you can simply use the business use as we did in the sole proprietor, if that's easier. Now, again, once you do incorporate, you need to register the business name and file the incorporation documents. Again, here we're serving New Brunswick, but again, any registry office in the other provinces. And when you first incorporate, you have 53 weeks to determine what your year end will be. So again, most corporations do follow the calendar year period, and they have a December 31st year end. But again, same as the sole proprietor, you cannot, other than the first year of incorporation, you have an extra week, you cannot exceed a 12-month period in your corporate financial statements. In other words, you cannot go more than a year. Now, you could have a June 30th year, you could have a December 31st, you could have a September 30th, for example. So again, depending on what your year will be, normally your year end would be what the business looks the best. That's why retailers usually have December 31st. That's the best the corporation will look in any other month of the year. They just had the Christmas sales. They've had all these things. They had, again, earlier break sales. They had, Boxing Day sales, all those type of things. Their business looks the best at that year end. In the event you want to sell the corporation or you want to do other things or raise capital, whatever the case may be, normally your year end will be, when does my year end look the best? But again, you're not guided by the calendar year unless you choose so. Now, the type of financial statements you would file would be one of those three. Compliance engagement used to be called the notice to reader. That's simply where, again, unless you're asked, you can actually complete and compile and remit your statements that you did yourself. Unless someone like a bank or someone said, no, we want those independently prepared, you can prepare and remit the statements yourself. If you want to hire an outside bookkeeping company or an accountant, whoever you may wish to prepare your statements, they would normally prepare a compliance engagement. All they're doing is pulling the information together based on the information you gave them. They're not reviewing it. They may add a few column of figures or something, but normally they're simply pulling together statements that you provided. Review engagement takes it up a notch. The fact that normally a lender, or if you have a contract with a certain company, they may want to see a review engagement. They want a copy of your financial statements. So the accountant would prepare a review engagement. And an accountant, in this case, would need an accounting designation. There's CPAs in Canada now. Chartered Professional Accountant in Canada. So again, they do a little bit more due diligence under a review engagement. Audits are normally larger corporations because, again, there are requirements to satisfy the preparation of an audit financial statements. Those statements would cost you probably double what a review engagement would be because, again, there's a lot more work involved because normally, even though you're paying the accountant to prepare the audit, they're usually done at someone else's request. That's where you use the examples of these corporations that go, the government has some assistance involved, and again, they've gone bankrupt or they closed or something. They want to see an audited financial statements because they want to see those things looked at very, very carefully. They do quite an in-depth analysis to prepare an audited financial statement. Q&A, because I think we're pretty well to the closing. And we can talk about some other topics. Sometimes I get questions on financing and those type of things too, raising money through crowdfunding and all that type of thing. But again, any questions on the presentation or anything else outside of what you saw today, you may want to field them, even have a discussion if you wish. Greg, it's your thoughts, I guess, on how you want to.
Yeah, there's a question that came in through the chat, and I'm sure more will come as people are typing them in. With regards to the incorporated side, the question is it similar to close an incorporated business as a proprietary business?
I would say, proprietor, you can close simply, again, you no longer, because you would complete on that form, that T2125, is this the final year of operation? When you're filing your T2 return, because individuals file a T1, corporations file a T2 corporate return, there's a box there too, they check the box, this is the final year of filing. So that's really all that's required.
That's all it is.
And you should notify the corporate registry, therefore they don't bill you every year for the annual return of corporations. And that way the corporation just falls off the registration list.
For sure. So any other questions? Here we go. So that's an interesting question. Okay, so 2 questions from Kelly. One, if you have products in shops on consignment, are they included as inventory? So they haven't been sold yet.
Yes.
You haven't received anything for them yet. So they're kind of.
I would say normal, again, I would say not, because you really haven't taken ownership of them. It's going to distort your statement. I'm just saying, I've seen it done both ways, actually, in fairness. Because again, on consignment, remember you're entering that as a lower of cost or realizational value. You haven't bought that. You haven't purchased that. It's only becomes a sale once it's sold. But the challenge becomes you're selling something and you didn't, and you would actually deduct that cost. Again, Greg, yeah, it's a little confusing, and I'm not explaining it very well either, because you really haven't taken ownership until it's sold. Because again, you could have that in there and it doesn't sell at all, so it doesn't really have any impact on your business.
Yeah, from the maker's perspective, though,
yes,
is that so I have my product in your shop. Is that still part of my inventory?
That's correct. It would be, yes.
It would be, yeah.
If you're the one that's producing it, yes, definitely. It's part of your just because consignment sale, that's just another way to sell something on consignment.
Right.
But again, I guess I wasn't talking, I think I was talking recipient as opposed to producing it. But if you are producing the product, you're right. It's treated like any other sale in any other
kind of the
inventory.
same as if it were sitting on my website.
That
It's,
is correct.
accessible for somebody to buy, but no, I still own the product. So it's part of
Yes,
my inventory.
that is correct. It's still yours until it is sold and you receive the money. So you may end up getting it back again.
Yeah. Yeah, that's right. Yeah, exactly. So you can't, and you're not going to have to buy it back. So it's still
Yes.
yours.
Yes.
Okay. The second question was, when it comes to precious metal findings, so this is a very industry specific question. When we collect and then send them for refining and sell it to the refining company, how is that income reported? So I'm finding a raw material, and then maybe we need some clarification for this. So you're sending it out to be refined and then selling it to somebody else? How is that income corrected? Maybe Kelly. And if anybody wants to jump on and ask their question, via audio, maybe that's easier.
Sure.
Kelly,
We can do that
maybe
too,
I'll
by all
ask
means.
Kelly to ask that question so that she can explain it. Kelly, if you don't mind jumping on your mic.
Hi there.
Hi there, Kelly.
Yeah, so we collect, scrap metal, jewelry makers, and we collect the scrap metal in the filings. And over the years, we've done this once before where we sold it back, to a refining company. So technically, that's material that we've purchased, but then we're selling it back and receiving income for that. So would I just report that as normal income, or
I would say it is regular income because that's the business you're in. Different businesses have different, categories of or sales, I should say. But if you've incurred a cost in refining that, that would fall under that heading. If I can go back here on the cost of goods sold here, that would be under subcontract or other costs. So therefore, if it's costing you to have that refined before you can sell it, that becomes part of your cost of goods sold or your manufacturing process, right? It's another cost you have to incur to sell it. But once you sell it, you're right, this becomes a sale or an income in any other. Yeah, that's correct.
Yeah. Okay.
Yes.
Perfect. Thank you.
You're welcome.
Cool. There's another question with regards to tracking your business trips. So let's say I'm going to a trade show where I have to track, travel costs and then accommodations and meals and all that.
Yes.
And samples, maybe I'm giving away samples at the event. So will that fall under my cost of goods sold, or is that somewhere else where I should
I
be
would
tracking
say
that?
that's administrative, or like that would be a normal expense, like it would be on this slide, for example, or depending if the corporation is going to show up in your financial statements. But again, no, you're right. Those are travel costs. You can include those under travel. It could be, if you want to break it, a lot of times it depends on what information do you want to make decisions. So if you want just under travel, that's great. But you say, no, I want to keep track of my accommodation costs too. Just separate it under a separate accommodation cost. If you're giving away products or something, that's fine because you've already expensed that production or the purchase of that cost. Therefore, it's just expense in its normal way. So again, you can track that however you want to travel. For example, the kilometers would be under the vehicle expense. The hotel would be accommodations or under the travel umbrella. However you want to track that information, you're right. So it really, the information you're producing is based on you to make conscious decisions. Now, you do have to file a tax return, but again, normally financial statements are there to help you too as a business owner.
Right. So yeah, so having that financial statement allows you to track it yourself and keep track, and then do it consistently year over year as well, right?
And you should try to have your returns done soon after your year end, even for sole proprietor and corporation, because again, you're making business decisions based on the results. And if you're allowing, and I've seen it before because I do the corporate returns, doing a company that's a year old. Well, you can't make decisions on something that on year-old information because the whole year has lapsed, and now you're ready to prepare the next year when you're still doing the prior year. So again, you really need that information in a timely manner. So I would say try to have it done within 90 days of the completion of your year end.
Okay. There's a question, Gary, and I know that we kind of talked about this briefly, you and I, prior to this session, about crowdfunding
Yes.
and whether you have advice about that, and do you need a license for it? How do you claim it?
Yes. Very valid question. Crowdfunding is not as popular as it used to be, simply because of the time that it takes and the money that you will find that you've raised. Now, CRA became involved not early on, and then all of a sudden, I'm going to answer the question, by the way. I'm going to arrive at the answer to the question. If you're going public, Financial and Consumer Services in New Brunswick, and I'm sure there's a federal agency as well as in every province, but right now in New Brunswick, I can speak for Financial and Consumer Services Commission in New Brunswick wants to know who's going out into the public arena to raise money, because they're trying to protect the consumer, because too many consumers have been, let's say they have expectations. Okay, I'm giving this company money. What do I get in return? Sometimes it's a gift. Sometimes it's a lending model. In other words, you're going to get an interest on your money you provided, or you're going to get a share. You're going to get like it's called equity-based model or reward model, or again, the donation model. It's simply raised money for the benefit of the community. Therefore, it's a donation. You're not getting anything back in return. So again, you have to define, I guess the point being, you have to define, I'm raising this amount of money over this period of time, and here's what you get for your investment. And again, it wouldn't hurt to register with these agencies like the Financial Consumer Services Commission, just so they're aware of, you don't get, because you may end up getting a complaint, and they want to be aware of what you're doing, what you're raising, and who you're going after, especially the elderly. Elderly have, been hit a few times on different things. Even though they're legitimate, they're, fundraising activities, they still want to know, what am I getting for my money? So just a word of the caution, once you go public, you do have to advise a regulatory body of what you're doing.
That's a good piece of advice. And then I have to claim that as income on my tax return.
Well, again, if you're raising, depending on how you're raising money, again, if you're giving equity, that's really, you're selling shares. So it's really not income in the sense you're selling shares to the corporation. It's cash and so on, but it's not income in the sense of a sale or something. You're raising equity. It depends on the model you're offering. Yes, it really depends on what you're trying to achieve and under what model.
So if I'm giving a gift or a reward as part of my model for whatever level of donation,
yes,
that you're offering me, what's the situation there then?
Well, again, I would say it goes under the equity part of it, because if you're giving shares or you're giving a gift or something, you're not going to return the money. So you're really raising capital. It's like going for a loan. It's new money coming in, but it's not considered income in the sense of a sale, because it's equity. It's another form of raising equity for your, and most of these are usually corporations that are doing this. So you're really selling or raising money for your equity. Is that confusing, Greg?
No, I think that makes sense. There's a question about, with regards to selling a product, what if you're posting a product and selling it as seats instead of tickets, as in a limited number of seats for a service or an event or something? I would guess that it would be the same thing as a ticket.
Well, a ticket will be a sale. You're selling, like you could be producing a product, but you're having an event. It's another form of income generation.
Yeah,
it is income coming into the hands of the corporation. You'd have expenses to pay the venue for that seat, for example. So you'd have expenses to offset that, but it is another form of income.
With regards to consignment, there's another question as far as how HST works for the maker and for the shop. Do you have any insight on that?
Well, again, you would have incurred HST on the purchase of the materials. Again, you're giving it to a corporation. Again, you wouldn't pay HST until you actually sold it. So if you're actually producing it, giving it to a third party like a retailer to sell, it's really not a sale until you're paid. Well, I shouldn't say that. I'll take that back. See, again, on consignments, you're a little bit of a leeway, but I know normally in the normal course of business, once it goes from sales to accounts receivable, CRA would want you to collect HST, and you'd have to pay taxes on that net income, even if you haven't received the money. Now, consignments are a little bit different because, again, it hasn't actually sold yet. But again, on the traditional sale, same as if I did work for someone on a business plan, I sent an invoice December 31st. I didn't get paid until January 12th or something. I still have to include that on my income source and HST in the year end for December 31st. So again, normal sales are required once it leaves your hands, but consignments are a little different because it hasn't actually materialized yet in a sale.
Right. There's a question about cell phone use and if there's any special treatment for that.
Not traditionally. Home phones are even are a bit of a challenge at times, but cell phones, if you're using it pretty much for business use, I would expense, and I expense my whole entire cell phone bill because I use it for work. I get the odd personal call, I get the odd text. But again, if I've really acquired it for business purpose, so I expense the full amount.
Yeah.
You could be challenged on that depending on, but I'm saying that I have a home phone for my other calls. I probably should get rid of that one of these days, but I still have a home phone that I do take business calls on to from at times. But again, yeah, those things like again are interpretation kind of, but you can make an argument on a cell phone that is
if you can justify that it's solely for business purpose.
Same as a vehicle. Again, you'd mentioned the other question about a vehicle. If it's solely used for business, then you can make that argument. CRA will always win an argument in an arm wrestle. However, it's worth to do that.
Yeah. And there was an extension to the question about selling seats and whether you would need a license to do so.
I guess that's depending on the venue. I know if you're selling lottery tickets, you have to register for special events. A seat venue, I don't know. I'm just thinking something like the Playhouse or something like that. If you're an organization that wants to rent that space for an evening and sell tickets, I'm not aware of any licenses that would be required for that. I think it's up to the venue to make that determination.
Yeah, that's what I thought too. You're just renting the venue, and then you make an arrangement with them about how you want to sell the seats or how you want to do that reservation process. But I don't think there's a special license unless unless you're talking about, it's an event where I want to serve alcohol to, and then you need to get
that's a whole different, you need a license, a special events license. The other thing you'd want to be cautionary about selling seats is the venue itself covering the liability insurance. Again, the slip and fall example, where someone decides to burn the seat they're sitting in, they didn't like the performance. Anything could happen. Look, anything can happen. Who's responsible for the liability? You may want to cover that. You may have to get special insurance or ask the venue, are they covering insurance? Because again, it is their venue. Just little things you don't think of necessarily, but you don't want to. I know at film production one time, we always get insurance. One of the films I was in recently as a producer, we had firearms and we had to advise the police. We have a firearm on set. It's not loaded. We have a gun wrangler on set, but we had to inform the police, and we had to get insurance just because of something would happen. Someone reported that. So again, things you don't normally think of, you should think of. Right. Just to protect yourself.
Yep. Okay. Last call for any extra Q&A questions on things that we covered or maybe haven't covered yet. If not, then I think we've all got a boatload of information that we can go home with.
And we're done an hour. We're done an hour early. Because normally there's a lot more questions are fired in, but no, it's fine. Again, I hope it's been informative. It may be boring to some, helpful to others, depending on where you are in your corporate or your business under sole proprietor. But again, everybody's in a different space, so it's hard to know the topics and so on. But that's a general broad view of those topics.
Yeah, no, thank you so much, Gary. That's, I think, really helpful and lots of good information for folks. And we're getting lots of appreciation in the chat right now for all that.
And if you want to share any feedback, Greg, anytime on what things, maybe other topics or things we went too fast, too slow, because I tend to talk fast at times, but
yeah, we'll send out a follow-up, maybe just like a quick, give us your thoughts type of survey after everybody. So,
yes.
or after
Okay.
to everybody afterwards.
All right.
All right.
That's good. Thanks everyone for being here. Enjoy yourself and hopefully enjoy the spring weather when it finally arrives and stays. And stay safe too. Stay safe out of harm's way.
Super. Thank you so much, Gary.
All right, Gary,
Take
my
care.
pleasure.